In terms of multifamily, it's always a good long-term bet because in 70% of the markets, we're not going to overbuild. You just have to, to know that. But they're going to be a little bit harder to get into, and they're going to be steady cash flow, and some of the other dynamics that are helping multifamily long term.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. Before we begin, I want to begin with reminding you that there is a website associated with this podcast called wealthformula.com. Lots of things there for your viewing pleasure, including the opportunity to join the Accredited Investor Club, aka Investor Club. That is where, if you are accredited investor, which basically means you make $200,000 per year, $300,000 per year if you're filing jointly, or you have a net worth of $1 million outside of your personal income. Well, congratulations, you are an accredited investor. You don't need to do anything else other than be your lovely self and sign up for Investor Club, where you will get deal flow. Now, that deal flow is coming to close to an end for the 2025 tax year. So if you're looking for tax advantage stuff that will help you reduce your tax bill for 2025, make sure you sign up sooner rather than later. And again, that's at wealthformula.com. So speaking of real estate, which we do a lot in the Accredited Investor Club, well, the thing about when you invest in real estate, you have to remember, now this, you're not buying what it is today. You're buying what it will become a few years from now. Okay. That may seem obvious, but I don't think a lot of people think of it that way, right? It's especially true in multifamily, which, despite all the noise right now, remains one of the most compelling long-term plays out there. I think you'll find experts across the board telling you that. Now, unlike stocks, you don't get a live ticker reminding you every 5 seconds what your property is worth. And frankly, I think that's probably a pretty good thing, because I could tell you the few things that I do have that are on tickers, I look at them too often. Real estate moves slowly, and that patient rewards people who can see the story before it unfolds. Now, what is that story? I mean, the national headlines are confusing. And it depends on, who you read. It depends on what market they're talking about. It depends on what class, because they're all moving in different directions, right? We're talking about, the froth in data centers. Meanwhile, we're talking about with multifamily being sort of on the floor right now, waiting to be resuscitated, right? Now, of course, you want to be on the side that's buying when something's being resuscitated, not in the frothy space. But anyway, the truth in real estate as a whole, it's somewhere in between because of this. The reality is that mortgage rates are still above 6%. That really does affect real estate. Affordability strain, national price growth has flattened. But beneath the surface, there is an entirely different story playing out, and one that really favors multifamily investors who understand that, real estate is always about location. Okay. So some markets are clearly going to be soft, and boy, I'm glad I'm not a New York City real estate investor right now. Can you imagine with Mayor Mamdani? Nothing personal there, but communism doesn't work. And if I was a real estate investor in New York, I would be absolutely terrified right now, right? But other regions, think about the Carolinas, Florida, even Texas, continue to thrive because people are still moving there in droves, because there's jobs there, because there's some affordability there. Jobs go, that's where people go, right? Jobs, climate, taxes, lifestyle. These are the things that are continuing to pull people south. They're moving inland. People moving away from California in droves. Why am I here? Well, because I don't know. I guess I've got something wrong with me. Now, when you combine growing populations with a shrinking construction pipeline, For example, new multifamily starts are down roughly 40% from their 2023 peak. So, yeah, there's more supply out there, but the new starts, meaning starting construction, new stuff, they're way down, right? You're setting the stage for tightening supply and rent growth in the right markets over the next few years. And knowing this kind of thing is what separates the pros from spectators, right? Anyone can read a national report, look at these big trend lines and all that, but the investors who are going to win are the ones who know their markets very, very well. Who's building what, where the jobs are moving, how the local policies are shaping demand. And in that sense, real estate offers something very interesting that is not available in the publicly traded equity markets, and that is insider trading. Insider trading in real estate is perfectly legal. Okay. Now, for passive investors, that means something's simple but crucial. Okay, you may not be the one living in all these markets to know all the nooks and crannies, but you got to partner with someone who does. You have to partner with operators who are on the street, have other properties in the area, are living and breathing it. You want people who are plugged in, not just reading spreadsheets, because in multifamily, difference between a mediocre investment and a great one can be a single zip code, right? Real estate, especially multifamily, it rewards patience, perspective, and proximity. As much as we'd like to, we can't control interest rates. We can't control what's going on with the economy, although I think it's important to try to understand which way it's going. For example, again, rates are coming down. What does that do for real estate, right? But aside from the macro stuff, if history is any guide, those who make smart, localized bets while everyone else is sitting on the sidelines tend to be the ones who look like geniuses a few years down the road. So this week on Wealth Formula Podcast, we're going to try to put some of this together. I'm going to talk with a former professor and renowned real estate analyst who's been studying these patterns for decades, and we're going to break down some of these interesting ideas like markets and opportunities and all that. So make sure to listen in, and I'll have that interview right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. As a result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Professor Norm Miller. He is a professor emeritus and former Ernest W. Hahn Chair of Real Estate Finance at the University of San Diego. He's one of the most respected data-driven voices in real estate economics, author of hundreds of studies on valuation, forecasting, market behavior, and former VP of analytics at CoStar, where he helped institutional investors interpret property data. Professor, thanks for joining us.
My pleasure, Buck.
So let's start with a question that I think a lot of us are wondering. Where are we in the cycle, right? You've seen every major cycle in real estate for decades. We've got lots going on right now, mix of high rates, inflation, low transaction volume. So what are we looking at?
This is a little bit unusual in that we are in a mixed bag where certain property types are doing well and others are not doing well at the same time. And so for some property types, we've not bottomed out yet, or maybe we've bottomed out and we're just turning the corner. And for other property types, we're clearly doing fine. So clearly a mixed bag right now.
We can break that down a little bit. Like what do you think has turned the corner? What has not turned the corner? Give us a little bit of insight on that.
Well, residential housing, which is important because it helps drive the rental multifamily market, is still soft. and our volume is about 30% below historical normal, and housing is not that affordable. So that in itself is one market we look at to understand multifamily. That keeps pressure on multifamily rents. However, it turns out to be very location specific. Certain markets have added too much supply, particularly, Texas markets as an example. Other markets remain tight, coastal markets.
Like the Carolinas, for example?
Yes, yes. And so we're seeing a rent softening in some metros while they stay tight in others in multifamily. On the other hand, we look at data centers, and we've overbuilt a little bit, but long term, we know the demand is just going to fill everything that it possibly can as long as they can get energy resources. So long term data centers are great. Right now, they're in a little bit of a soft spot. You need pre leasing. Industrial continues to do well because e commerce continues to do well. It's taking a little bit of a hiccup with the tariff impact, maybe in end of this year, early next year. But warehousing in general is a good long-term play. Office is a mixed bag. It's turned around in some markets, and leasing is on the upswing, and you can still get office properties for 50 to 80% below cost to replace them. So if you have a conversion use or you're in an AI-driven market, you can do well. So as I said, it's a mixed bag. Retail's pretty much already gone through the shakeout of e-commerce. Most of the new tenants are services, experience-based restaurants, and so retail can be a good play. Again, you need to pick the right markets.
Audience is generally very interested in multifamily. And if we go back to that, talk about some of the dynamics that are sort of creating that softening and, kind of what some of the variables are that you're looking at to see when this, bottoms out, starts to take off. Give us a sense of that.
In the multifamily market, we have some really large developers and builders, sometimes they do single family and multifamily both. And I think what's happened is they got so much brain damage on the coastal markets like California and others, where it's so hard to get entitlement and develop, that they've retreated to the markets where it's easier to get permits. Supply is more elastic, we would say. And so they've concentrated in those markets. There's a lot of capital sitting on the sidelines, and the large developers with a good track record attract that capital, and they continue to put it to work, but they've overbuilt in pockets. Multifamily that is existing product is affected by that overbuilt stock, because the new high quality stuff beats out the older stuff. And so in terms of multifamily, it's always a good long-term bet, because in 70% of the markets, we're not going to overbuild. You just have to, to know that. But they're going to be a little bit harder to get into. And they're going to be steady cash flow. And some of the other dynamics that are helping multifamily long-term, our home ownership rate appears to be stabilizing, maybe even declining because of the higher interest rates. And also, we must keep in mind that the standard deduction for a household is now, in the low $32,000 range. And it turns out that 60% of the households in the United States cannot take advantage of itemized deductions. That is, when they take the mortgage interest, property taxes, charitable deductions, they don't hit that number. And so there's not as much benefit to home ownership as there used to be.
Is there a difference when you break down, even within multifamily, because you were talking about certainly in certain parts of the country where there's overbuild, obviously mentioned there's some areas that are, looking better, like the coastal areas in Carolinas and stuff. But what is the differences that you see between, say, the units that are competing with the new builds are usually Class A units, right? But there's also sort of the more working class stuff, the B class, those type of workers. Can you segregate out what's happening to those kinds of properties as opposed to sort of the ones that are competing for that, A class new build?
Yeah. So one of the problems that we have in the real estate industry is that depending on your market, entitlement development fees might be fixed per unit. And if they're high, as they are in the coastal markets, so let's say that your development fee by the time you get a unit set up, approved to build, it might be $100,000. Very high regulatory cost, entitlement cost.
Yeah.
Now, if it's per unit instead of per square foot, then you have an incentive to build a larger unit. You can't really build a small, affordable unit when you start with this fixed cost that's so high. And so most of the development of multifamily is done at that higher end, high quality Class A and larger than the market as a whole would typically want for the working class housing market, which is very strong. But they can't afford to build the small units. They can't make it feasible. So we really have a regulatory problem. But as long as we tend to lean towards charges per unit instead of per square foot, you're going to see it's very difficult to add working class housing in this country.
Yeah. So let's switch to another topic. There is certainly not as much liquidity in the multifamily market as there used to be a few years ago. One of the reasons, talk about cap rate spreads, context, essentially the yield investors expect from real estate usually trade above treasury yields. That spread's narrowed dramatically. And so how unusual is this historically? And what does that tell us about pricing pressure or investor sentiment right now?
You're right. In terms of the yields right now, let's just use logic. If you can get 4% in treasuries and inflation is running 2.5%, and you want a real yield of 4%, then you need at least 6.5% going in, right? And so we'd expect to see cap rates in that range or above. And in fact, for multifamily, we do see cap rates in that 6 to 8% range, depending on where you are. The large institutional investors, I think they have so much money that they have to allocate that they're going to have a tough time getting out of the single digits in terms of their long-term yields. They're just going to outbid each other because they need to deploy so much capital so quickly. The private wealth investors that can go down a little bit lower than the institutional plays, a little bit smaller asset size, can consider a 5 to 10 million property. They're generally going to see a premium of between 100 and 300 basis points higher yield than some of the institutional players for a similar risk property. And so you may not have a choice as an investor. If you're stuck with a pension fund and you allocate some to real estate, you're going to get those lower yields because they have to allocate capital and because you have so many layers of fees. If you have discretion, that private wealth investors are going to get higher single digit to low teens on the typical existing stabilized properties. With a little bit of leverage. Now, leverage is not that easy to use right now because the interest rates are high, but some of the players are using variable rate debt, and if the rates drop, they're going to refinance, and they're building that into their pro formas, and it's likely over the next 10 years, we're going to see some of that. So you might go in with a cap rate of 6.5 and still come out with a yield of 10, 12%.
Right. These interest rates drop. Would you expect more of that money to come out of treasuries and join the market? I mean, part of what I'm seeing right now is, the big players. I mean, it's not like it was a few years back where, multiple properties are out there. There's not a great amount of liquidity. There's not a lot of properties moving,
So right now there's at least $3 trillion sitting in money market funds. And I bet a lot of your listeners have money market funds. I have money in tips. I have money in money market funds. I have money in places that I normally wouldn't keep it, except that I'm being defensive with the stock market right now and not over allocating. You're absolutely right. As interest rates drop, that'll be less appealing as a place to park money. And that money, $1 trillion, $2 trillion, is going to go back into stocks and to real estate. And so that does help keep cap rates down and values up. And we can expect as interest rates go down, yes, absolutely, the asset values are gonna start moving positively, even office property.
Yeah. Let's talk a little bit about valuation. Appraised values haven't fallen nearly as much as actual deal prices, right? So why do valuations lag in private markets? And when do you expect price discovery to finally catch up? I mean, I guess part of it is just human nature, right? Like you bought something at a higher price and you don't want to sell it if you don't have to. But, what's the inevitability?
Well, you bring up a good point, and appraisals have fallen closer to transaction prices in the UK and in Europe. But in the United States, with our big institutional players, nobody wants their appraised values to be quickly marked down to market, because if your competitors don't do the same thing and they're part of the index and benchmark that you compete against, you're going to underperform. And so we've traditionally had a lag in appraised values for real estate among the institutional players, especially. You don't get this out of the private market, but you get this from the NCREIF players, the institutional type players. And everybody's fearful of underperforming that index. I would prefer, as a private investor, just to go ahead, bite the bullet, and mark it down now, take the pain, if in fact you've seen it go down. And some markets have seen property values go down 30, 35%, even in multifamily. But they bottomed out in the transaction market, and absolutely the appraisers are going to have to bring it down, and the owners are going to have to ease up that pressure and say, yes, I want a realistic appraisal. But there is that fear of underperforming the index, and that's what's holding up the American appraisal firms.
So we are seeing, just in terms of transactions I'm seeing, and, not as many deals, but the deals that fall through, the deals that come to us rather, tend to be ones that are distressed financially, right? They may not be distressed in the sense that it's not a nice asset, but they're underwater and something's coming up due, or, there's a big fund that needs to close out and you end up getting a 30% discount compared to sort of the highs a few years ago. When you see that at this point in time in the cycle, does that, certainly not asking you for investment advice, but do you see that as like, okay, you're 30% down now, is there any reason not to pull the trigger?
Well, it takes guts to pull the trigger and to say we're at the bottom. It takes guts to do that. Now, when we get a couple years past it, everybody else will say, oh, yeah, buck like that. It's not luck. It's guts. And in fact, we probably are at the bottom in some property markets. So, yeah, go ahead and rephrase that for me, please.
Well, I think the point is, like, people are seeing deals now, right? We're seeing deals. I'm seeing deals. And it is a good asset. And all of a sudden you're seeing somebody, a group having to get out of it, and they're losing all of their equity, 25, 30, 35%. And the question I think a lot of investors are asking themselves is there any reason for me not to do this right now? Because it sure seems like, I'm getting a good deal. I mean, I guess what I'm asking is there blind spots that we should be focused on? You bring up guts, which I think is, I mean, that's my own take is that, yeah, I mean, I think that if you look at the macro trends and rates coming down and you're getting something 30% marked down from a few years ago, it's probably a pretty good bet. But I'm just curious in terms of your, just as a macro real estate person, like blind spots or things to think about, or,
Let me put it in context. In 2008, 9, 10, 11, we saw a lot of deep distress. And the smart money was ready for it. Now, there's a lot of people with dry powder, as we say, ready to pounce on the market, hoping for some distress from those who cannot refinance now, whose CMBS loan or other money is rolling. A couple points there. One is, I think you're going to see more loan modifications this cycle than last time because they realize it's temporary and they realize that not all properties are in trouble. And these tend to be the higher leverage properties. The smart private wealth investors tended to use conservative leverage over the last several years, knowing we'd hit a cycle, and they probably are 65% or less leverage. Some of the greener, newer investment managers might have gone up to 80% and might have even used variable rate debt when they shouldn't have. They're the ones getting nailed. They're losing all their equity. And that property is distressed. So there's not that much of it out there, but there's a little bit, and I would certainly pounce on it if you can find it.
Right.
It is a good opportunity. And again, it's because of a small subset of investors, not the whole market, 20, 30%, went ahead and over leveraged and used variable rate debt and they cannot roll now.
Yeah. Yeah. 100%. And that's what we're finding. It's like, there's not that many deals, right? But when there is, it's like, all the things came together. It's, for example, we have one where a partnership broke down and nobody wanted to do anything with it. They were underwater already. They just wrote it off. We're an institutional group that had a fund that they need to close the fund out. They're just, they're done. And, they're going to write it down. The rest of the fund is okay, whatever. Those are the kinds of things. We're not seeing a lot of it, but, let's talk a little bit more. I know you talked a little bit about the regional dynamics, but, for our listeners, talk a little bit about how migration and job growth really reshape the landscape of these markets over the past few years that are doing well, or maybe some that you thought were going to do well, people thought were going to do well, it didn't.
Well, what's interesting is predicting migration has been an economic nightmare because we just haven't been able to get the assumptions down correctly. It's interesting, when Trump was in his first term, the data from the budget office suggested that immigration would drop very low until the end of his term, and then whoever was the next president would dramatically increase the immigration rate. And so it was really interesting. It was like a 4-year drop and then 5-year increase and then more immigration. And in fact, it took a couple of years after that for the immigration to come back. But now it's going back towards zero again. So
yep.
We now have to look more at fundamental net population growth to know which markets are growing.
And that's jobs, right? I mean, is the biggest thing right there is jobs. Where are the jobs? That's where the people are going to go.
Well, jobs are part of it, but we also have these baby boomers like myself that are location free. And we had a big exodus from the big cities, when we hit COVID, and a lot of people retiring. And we're still seeing decentralization. So we moved from the first-tier cities to the second and third-tier cities, where people were chasing lower cost of living, selling out the more expensive house and buying the same type of house in a smaller city. we've seen that. I think we're going to continue to see that. And the immigration that's being pulled back, it's interesting that it actually hurts the markets that demographically haven't been growing the most. If you look at the New England states, they were already in net zero population growth a couple of years ago if you only had your domestic births minus deaths. So they needed immigrants. And we tend to think of the immigrants going to Texas and California. That's true, but they have positive demographics still in terms of births minus deaths. So it matters a lot. And the retirement matters a lot. And we're getting this flow, not just towards jobs, but towards cities that are well managed, that are not quite as expensive. Those second and third tier cities have benefited from the work from home movement, the demographic trends, the location free baby boomers.
Yeah. What are some of the some of the markets right now that are sort of the fastest growing?
You're going to see some of the ones that have high vacancy rates and lower rents and lower prices grow pretty fast over the next few years, but they're being pulled in by the overbuilding and the oversupply and the high vacancy. So you're going to see really positive numbers in Texas for migration. It doesn't mean that it's the best place to invest in terms of all the markets there, because it takes a while to absorb that oversupply. So, I tend to look longer term at cities where it's not as easy to build and they're well managed. So I look for cities where they don't have huge fiscal deficits, where they don't have old pension overhangs. Cities like Denver tend to be fairly well managed, fairly well planned. They're good for the residents that are living there, and they tend to attract migrants as well. Now, one of the problems that we get into is cities that attract people. Seattle did for years because of jobs, and it was fairly well managed for a while. The problem is they start putting up more regulations and making it more difficult to add supply. But that's only added to their pricing power and to the investment returns. So I would tend to focus on cities that benefit from the AI tech boom and well-managed cities that don't have big pension overhangs. So I hate naming names on the negative side, but there are a lot of cities out there that are on the verge of bankruptcy. That means they're going to be raising taxes on companies, and those companies are going to look elsewhere. And I would avoid them. But we have a lot of good markets.
Yeah, certainly one of the advantages of Texas, a lot of companies moving there on an ongoing basis just because of the tax advantages and that kind of thing. So let's talk about a little bit.
And long term, they would do the same thing. They'll start adding more regulatory barriers and making it harder.
Right.
And if you can find distress in Texas, sure, you can do very, very well.
Let's zoom out a little bit. You mentioned AI, and it's a very interesting thing to me to think about the big picture effects. The artificial intelligence, this era accelerates automation, reshapes the labor market. How do you think this ripples through real estate? And I'm talking beyond just data centers, right? I'm talking about people have to live somewhere, and how does AI affect that? How do that jobs? It's an incredibly complex thing to think about, but I'm curious what your take is.
So think about prop tech. And if I'm working with an investment manager, I want them to be utilizing prop tech that works. So as an example, prop tech that works and eliminated some jobs. Investor reporting. I should have a portal that I can use to get on to see what my investment is and how it's performing. And you're going to get that with your leading vendors, Juniper Square and AppFolio and those types, not to endorse anybody.
Mm-hmm.
Think about tenant communications and management. I want to work with an investment manager that gives every tenant an app that can put in a work request and makes it easy to schedule. I want to work with a property manager that knows how to let people use their phone instead of a key to get into their unit. And they control their air conditioning and their TV and their internet. And it turns out they're willing to pay $50 to $75 more per month for a sophisticated property management system. And the return on investment for the property owner is terrific. So there are a lot of apps in terms of working with tenants, working with investors, valuing property, managing property, energy efficiency. And all of that was originally AI driven, if you will. It's technology, it's data mining. I want to know that my investment managers utilize some of them, but I don't want them to chase everything because 80% of these prop tech vendors are going to be out of business in 5 years. So they have to pick cautiously and carefully vendors that will stay in business. But it is revolutionizing how we do business. Another example, a burgeoning market is single-family rental. Single-family rental was very difficult to manage 20 years ago and before. I mean, you had to buy a cluster of them so that you could get your maintenance guys and your property managers to efficiently take care of those properties. Now, it's all on a phone app. And it's all done through the internet. I can do the leasing. I can have documents signed. I can collect rent. I can manage that property without necessarily having to be there. Now, I may have to have a good, handyman network that can get there and have some economies of scale. But that's an example of where AI technology has really expanded an asset type, and that will continue. A third of the rental market now are single-family homes, so more than a third. That's incredible. It might continue, both for reasons that we discussed before about the standard deduction, but it might also continue to the extent interest rates stay out for a while, and it's a much easier asset to manage. So you do need to utilize prop tech. You do need to expect will change the labor market. There will be some people put out of jobs, but that's no different than happened when we invented the loom or the tractor or the internet started or, any number of other technologies.
Yeah, no, that's right. So, I mean, net AI, like many businesses, makes them more efficient with real estate. I mean, AI is going to help with probably bringing expenses down. And
yeah, and it will. And some people are fearful that we're going to have this huge labor layoff with AI. It's going to take a long time before we're replaced by robotics. And if you go to an Amazon warehouse, they've been doing that already for many years. They've been using these little devices that carry things around and automate things. It's just going to be a progression of that. And then when we lay off people, there'll be new jobs that you and I haven't ever heard of before. I have a stepdaughter that on the side is a yoga instructor. I doubt that we needed many yoga instructors 50 years ago. I have colleagues that do life coaching, career coaching. Those jobs didn't exist 50 years ago. And I bet we're going to see a lot more evolution of jobs that don't even exist today.
What's one, golden piece of advice you'd leave investors with today? A bunch of investors listening to you talk, and given where we're at, what's going on today, how should they approach, the market? How should, if you had any words of advice for them?
My own biases would be don't work with an investment manager that is so big that I'm nothing more than a Social Security number. They are the market. they drive the market. I would think the most important thing, more than telling somebody where to invest, is finding people that are experienced that I can trust. So coming up with that trusting relationship, doing your due diligence on the people more so than on the property, Now, you should look at what they're buying and have some opinions and some views on that. But finding experienced people you can trust to help manage your money, that's the most important thing.
Yeah. Professor, thanks so much for joining us on Wealth Formula Podcast today. It's been good talking to you. Do you have anywhere that you post or write that we can look up?
I do write a number of places. I write on LinkedIn sometimes. I write for the Property Chronicle. And in fact, I just did a review on the economy with a little more detail than we went into today, and some property type reviews. And what I usually do is post those on LinkedIn after they come out. And there's a few other publications as well. We have a University of San Diego Bryn Mawr Real Estate Center. Well, I will publish as well and communicate. Sometimes it's career advice for the grad students, but sometimes it's the economy and the commercial real estate market. So I'd be pleased to have people connect on LinkedIn and see some of my blogs.
Thanks for joining me today.
Thank you.
You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s. Now you're trying to catch up. Meanwhile, you've got a mortgage, private school to pay for, and you feel like you're getting further and further behind. Now, good news, if you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator, and it can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. If you noticed, they're talking about the Carolinas again. And that is something that I think you probably, if you are in Investor Club, you know what I mean. We're just, that is an ongoing theme here. The Carolinas are looking ripe for investment. Anyway, hope you enjoyed this show. I know it was sort of broad strokes on a lot of things, but I think it's important to have an idea of what's going on from the perspective of an analyst who's been around for a long time. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off. If you want to learn more, you can now get free access to our in-depth personal finance course featuring industry leaders like Tom Millwright and Ken McElroy. Visit wealthformularoadmap.com.